Good afternoon, everybody. It's Jed Joling here with eXp Realty in Southern Oregon. I've got another Southern Oregon market update for you for today, Tuesday, November 28th. I hope you all had a wonderful Thanksgiving time with your family and friends and ate lots of turkey, and then hopefully went and did a lot of shopping after that on Friday and Monday. But anyway, we're going to jump into it here. I've got some data locally for Jackson and Josephine Counties, and then I'm also going to fill you in on some of my opinion on what's going on with the big picture in real estate right now, as a whole, nationally, whatever you want to call it. So currently, this last week, starting last Monday through this previous Sunday, just a couple days ago, we had 64 new listings hit the market, 66 listings went pending, and 37 closed. Now those are some lower numbers, but it was Thanksgiving week, so that's our anomaly this time. Our 4-week average is currently running at 77.5 new listings, 76.75 pending listings, and about 70 closed listings a week. So obviously you can tell we were definitely below those numbers. I'm not going to make a big deal out of it because it was Thanksgiving. But we will compare this last week to the same week last year. Last year for Thanksgiving week, we had 37 new listings. So we were actually up 42% if you compare this week to that week for this year. We had 50 listings go pending last year, that week of Thanksgiving. So we were up a little bit this year from that. And we had 40 closed that last year, Thanksgiving week. And so we are actually down just a few this year on that number. Right now we have 1,044 active single-family homes listed in Jackson and Josephine counties. We are just down 4.7% from where we were this time last year at 1,096. Right now that brings our inventory based off our 4-week average to 3.5 months of inventory, meaning that if we stopped all new listings today, it would take us theoretically 3.5 months to go through what we currently have on our market before we ran out of homes to sell. The interest rates right now on a 30-year conventional, the national average is 7.3%. And that's the fixed 30-year conventional rate. The fixed 30-year FHA rate is at 6.62%, and a year ago that conventional was at 6.62, same as what the 30-year FHA is today, and then the FHA a year ago was 6.12%. So we have seen rates starting to trend back downward this last month, and hopefully that trend will continue through the new year as we are starting to see some better data for the economy. Speaking of that, we're going to go through a little bit of what is and how is the market doing. So this last month of October, the core CPI was down to 4%, which if you don't know what the core CPI is, it's the Consumer Price Index, takes into account cost of everyday items, clothing, food, energy, just everything all compiled together. So that core CPI was 4%. For the month of October. That's a 2-year low. The core CPI does exclude food and energy prices because they tend to be more volatile, but the CPI, including the food and energy prices for the month of October, was 3.2%. So we're getting a lot closer to that 2% target that we want to see on that inflation rate. Speaking in terms of the real estate market now, instead of what the inflation is, each week, we are still seeing about 10% of the new listings go pending, which is a good sign. Those are, of course, going to be affected by what the price range is. A lower price range in this market with high interest rates is going to have a lot to do with that. So things in the $300,000 to $400,000 range are certainly going to sell much quicker than things in the $800,000 to $900,000 range. But presentation and pricing of the listing also plays a huge part as well. So you still do see near $1 million listings going pending in a week sometimes. And that's just has to do with presentation, pricing, and how that's put on the market. So we still have quite a few listings moving in this market, regardless that it is a slower time. And a lot of that has to do with the people coming into our valley. We have, obviously, as everyone knows, a lot of Californians coming up here buying, and if you look at the real estate markets in California, they're still moving rather fast. So I took a quick look at the Bay Area, California, and just some quick numbers. And these are honestly from Redfin, Zillow, and some of the Realtor.com data, but they're fairly accurate. So average days on market or median days on market for San Francisco was 24, Sacramento 13, San Jose 13, Stockton 19, and I was looking at lots of several in between cities like Walnut Creek and Brentwood, and they were all in that teens range. So stuff down in the Bay Area is still selling rather quickly, and then those sellers down there are able to come up here and get a lot more for their dollar than what they sold down there. So that does help keep a lot of our market moving, and I have worked with a lot of Californians migrating to Oregon in the past year or two, and that does play a big part in my business, as well as I'm sure a lot of other agents' businesses up here as well. So I want to also touch on, I've been getting asked a lot seasonally, it's the question, how is the real estate market doing? Do you think there's going to be a big crash? Everyone keeps talking about a big crash, similar to 2007 and 8. And I personally just don't think that's possible, and I'm going to go over why. So my first point here is going to be, we would need to see a lot more delinquent mortgages. And right now the current delinquency rate on mortgages is 1.72%, and that's been declining. And it's been declining since 2012, with the exception of Q1 through Q3 of 2020 when COVID hit. It did go slightly up those quarters, but now it's back down under where it was even then. So that's my first point, is I think we need to see higher delinquency rates. Even those that are delinquent, that are into pre-foreclosure, there's still a large amount of equity in the majority of those, and they should, if they're smart enough and know this, just know how to get out, they should be able to contact an agent and sell before they get into trouble, because they should have enough equity to get out of those homes. And then my second point here is going to be the amount of mortgage holders that have lower interest rates. So this is according to Real Deal Real Estate News. More than 80% of mortgage holders right now have a mortgage of under 5%, a rate under 5%. More than 60% of mortgage holders have a rate under 4%, and close to 25% have a mortgage rate under 3%. So you've probably heard me talk about this before if you've watched my videos in the past. These people, a lot of them are going to be gridlocked. Essentially, they can't sell and afford the same thing they're living in now. So why would they sell, just to go rent? So a lot of these people are going to stay put. In fact, another statistic I saw was 82% of mortgage holders right now feel like they are stuck in what they are currently living in, whether they like it or not. But 82% said, basically we couldn't move, or we wouldn't move because we couldn't afford it. So there's still going to be, of course, people out of this group that are going to sell for reasons of, marriages, divorces, death, job move, relocation, and, some families are just going to need a larger home regardless. So there are still going to be people in that category that do sell. But I think that because of the phenomenon that we had and the low mortgage rates that we had for the COVID years, it's going to keep a lot of people in those homes, and it's going to keep our inventory lower, I believe, because of that. So that's my more or less major point of why I don't think we're going to have a large crash, is because we would need to have such an influx of listings on the market. If you look at what we have currently on the market nationally right now compared to what we did, prior to the crash, right now we're sitting at like a seventh or an eighth of the amount of active listings that we did prior to the 2007-2008 housing market crash, and that was started by mostly the subprime mortgage lending with some other factors in there as well. So that's my take on that, personal opinion. I'm going to go over right now, just real quick, where we are from homes sold from January 1st to October 31st in Jackson and Josephine Counties. So combined right now, for 2022, from January 1st to October 31st, to give us kind of a something to go off of, we had sold 4,219 homes. And so now 2023, from January 1st to October 31st, we are at 3,027 homes. So we are down 28%, or 1,192 less homes sold. So we're certainly down from last year, but we're actually we're actually not down as much as I anticipated to see it. When I was looking at those numbers, I anticipated to see us down a little more, like 35% from last year. So that is is not bad. We're down 28%. Obviously, high mortgage rates. A lot of people can't afford to buy. So that's pretty much all I have for today's market update. Hopefully that gives you a little bit of insight on what is going on and some of my opinion also of what may or may not happen also. And of course, if you have any other questions, feel free to reach out to me. You can reach out via email or my cell phone, 541-761-7770. More than happy to answer questions or help you pursue buying or selling real estate. So everyone have a good rest of the week, and we will see you next week. Thank you. Bye-bye.